Hello, Internet. My name is Ryan Ingram, and today I'm going to tell you exactly how I managed to get paid over $7,000 for buying a rental property. A rental property that I rent out and collect cash flow on every single month. If you're new to the channel, what I do here is explain everything that I know about real estate investing, and I'm very transparent about exactly how I'm doing it. The only thing that I ask you is that you like and subscribe. Now, I know I've said this a lot. I don't want to be the boy that cries wolf, but I think this is one of the best deals that I've done yet. I'm really pumped up about explaining this and taking you through how we were able to make money on the deal, both on the purchase, in equity, in cash on hand, and how we're going to continue making money every single month. So, let's talk about it. Let's start with the purchase price. So the purchase price is $22,500. This property was on the MLS. This was not done through a wholesaler, and a realtor didn't bring it to us. So we saw it on the MLS it was listed at $34,500. Now, when we saw this, we took a look at it. I drove past it. I was trying to figure out what kind of shape it was in, if there was any deferred maintenance. This is all before I contacted the realtor. My brother and I spoke about it, and we decided that we wanted to offer $20,000 for the property. Because it was on the MLS for so many months and it hadn't sold, we figured that we were going to put in a cash offer. We'd be able to close within 2 weeks, and in theory, everyone would be happy. The seller countered at $25,000, and we came to an agreement right at $22,500. Now, the garage of this property is in rough shape. That's how we were able to counter at $22,500. We figured that the garage door was going to be around $2,000, and the man door was going to be around $500. And we agreed to take care of the gutters, the fascia, and the siding and the fascia that you could see here. As you can see up here, I think the after repair value of this property is $60,000. I put an asterisk beside it because I wanted to remind myself to let you know that the $60,000, that's going to be full retail price to a homeowner, somebody that wants to own or occupy the property. In order to get to that price, we're probably going to need to replace the kitchen and the bathroom, really bring it up to speed, make it look really pretty, and that's probably going to cost around $10,000. So there's still a decent equity spread in there, probably like right at $30,000 if you take out the expenses that we would need to incur in order to renovate that. But still, that's a great amount of equity. So just for argument's sake, let's say there's $25,000 worth of equity that we were able to immediately make just on purchasing the property. That in and of itself, I think, is a giant win. In addition, this property already came with a tenant. It's a 4-bedroom, 1-bath house. It was built in 1919, and the tenant is currently paying $750 per month. Now, it's a 4-bedroom, 1-bath home. There's actually a shortage of 4 bedrooms here in the area. So if you were to rent this out to Section 8, you could probably get around $1,050 to $1,100 per month. If you were to rent it out just as a 4-bedroom, you could probably get $950 or $1,000 outside of Section 8. So this is under market, and we're going to work on raising the rents. I'm not sure in what manner we're going to go about doing it. If somebody's been there for a really long time, if they're a good tenant, which these people have been there for a few years, then I don't like just arbitrarily purchasing a property and then raising the rents just because it's in my ability to do so. I really like to work with people that have been there for a long time. On a side note, we recently purchased, well, it's been a few years ago now, but we purchased a property where the tenant has been in there for 25 years. He has been paying $395 every month, and we've owned the property now for 2 years, and I don't think we're going to raise the rents on him. I think as long as he wants to live there at $395, we're going to let him. We're only making $30 per month on that property, but that's okay. He's pretty much purchased the home. So it's my personal preference. I understand this is a business, but again, I like to have a heart. I don't like to raise rents for no reason. All right, so there is room for growth there. Now, for our monthly expenses, our mortgage, Our mortgage is $250 per month. Now this is how I made the $7,000. Because the purchase price was $22,500, because the ARV is so high, because we have so much equity in the property, because we were able to talk the seller down from $35,000 all the way down to $22,500, I was comfortable taking out a $30,000 loan. I borrowed $30,000 from a good friend of mine. The terms that we agreed to were 10%. These are interest-only payments for 3 years. And since we're good friends, and we've had a lot of real estate transactions together, the trust level is very high. She's probably going to watch this video at some point and laugh about all of this. So the option that we included in this loan is because she loves lending money and I love borrowing money, and we would just do it again if this were to be paid off. So what we did is we wrote in the contract that at 3 years, she can call the note whenever she would like, giving us a 30-day notice. However, we also have the ability to just make it an open-ended loan. So it's callable after 3 years. It's not callable until 3 years, but after 3 years, she can call it at any time, which is fine because this property isn't going to do anything but appreciate. And other than that, this is just going to be an ongoing loan. So that is how we financed it. The mortgage, $250. The insurance, I know a guy, is $35 per month. The taxes are really high on this property. I'm probably going to dispute these taxes. It's looking like the tax assessed value is around $50,000 since I purchased it for $22,500. Here locally, they generally go off the purchase price. So if the tax assessed value is higher than the purchase price, you can dispute it and say, I get the assessment. I love you, government, but in this case, I think it's a little high. Here's why. I just bought it for $22,500. And generally, they go with a lower amount, your purchase price, and they will correct the taxes. So I hope to do that here because currently the taxes are a little bit over $1,200, somewhere in the $1,300 range. But for argument's sake, we're going to say that the taxes are $100 per month. Property management, that's $60 per month. Again, we are at 8%. So that brings us to $445. So since the income of this property is $750, all of the expenses are $445. So even after taking out a mortgage of $30,000 at 10%, we're able to clear $305 in cash flow per month. That's pretty awesome, right? Now, as I mentioned, we could also go and raise these rents if we wanted to increase this. Probably we have enough room to increase it by $200, which would take us to a little over $500 per month in cash flow. And, I would call that the pro forma. That's what we could charge. That's what this property could perform at. But like I said, my brother and I are still having conversations about whether or not we actually want to raise the rent or just let the tenants live here for as long as they like, since we're comfortable in our cash flow numbers. So what are your thoughts? Comment below. I'm interested to hear what you think about this strategy. I know getting into real estate with no money down is a really big thing that a lot of people want to learn about it, and it's possible, it's doable, and I think you should do it. But at the same time, you also need to be smart about how you do it. You need to understand that the cash flow is still incredibly important. Just because you can buy a property for no money down doesn't necessarily mean that you should. If you're able to finance a property for more than you purchased it for, I think you probably should. But at the same time, you need to be careful. You need to go through all your numbers, make sure that it works. In addition, you don't want to find yourself in a position where you don't have much equity in the property that you won't be able to refinance out of later. So when I say that I'm comfortable taking out more than I purchased the property for. What I mean by that is, sure, we're over 100% leveraged on the acquisition and the rehab costs on some of these properties. However, if you look at the after repair value or what the property would appraise for, we're still in the 60 to 75% loan to value range, which means that if we approach a traditional lender and say, hey, here's a property that I purchased a while back, I'd like to refinance with you, the bank would say something like, well, we do 70 to 80% loan to value. In that case, we're in the clear. So we don't have any of our own money in the property, but at the same time, since we're buying these from motivated sellers, since we're buying them sometimes in a distressed state, then we're able to get a lower, maybe 40 to 50 to 60% of the actual value, because these people just want to get rid of properties as quickly as possible. So look forward to talking to you again. Thanks for watching these videos. Check out the other Deals Explained videos where I walk through exactly how I purchased all of these properties, how I financed them, where I found them, and how you can too. So thanks again for watching, and let's go out and build some wealth together. Thanks.